Good, how are you? Let's get into it.
Let's do it. Welcome to the Money Storm Show. This is a place of discussion about all things money and how to weather the financial storm. Without further ado, you have your hosts, Chet and Larry. You have Chitani Monga, otherwise known as Chet, the founder of Brightcap Financial, a commercial and alternative mortgage brokerage. You also have Larry Heron, the founder of City Center Mortgages, a mortgage brokerage which specializes in residential mortgages nationally.
Yes, thank you, Chad. Welcome back, everybody. We are live now on episode 7. It's going to be a little bit of a short one. My partner here has got to jump on a ferry, or you're leaving tomorrow, a little bit later on tomorrow, right?
Yeah, I'm gonna leave tomorrow morning. Gonna go head to the island.
Souk, BC, you mentioned.
Yeah, Souk and a couple other places. Gonna do some site visits and stuff. Visit a few clients. So just gonna check it out.
That's awesome.
Yeah,
activity is picking up. That's the fun stuff, right? We're back out there on the ground.
Yeah.
I mean, you're jumping on a ferry, going up to Souk, BC, going to visit your clients, check out the site.
Yeah.
Things are moving along, right?
Things
That's
are moving.
awesome.
Yeah.
That's awesome. So we'll jump into our episode, guys. Thought we'd add that blur because the episode's going to be just a tad bit short, but it's going to be super valuable. From the residential end, I'll get going. I want to talk about a hot topic, Chet.
Yeah.
What to do if you're in a variable rate mortgage.
Absolutely.
It's tough for anyone to navigate this thing right here. You're in a variable rate mortgage. You know your rate's gone up, and you don't know what to do. Right? Essentially, you don't know what to do. You're going to call your bank. You're going to call your broker, but that call does need to go out because you do need to investigate. Right? Anybody in a variable rate mortgage, they can't just coast. Right?
No, absolutely not.
The coasting days are done.
It's time to take action. Right?
Yeah. So it's time to take action, and I just want to run over a few quick examples which hopefully can add some value and help some people that are sitting there at home thinking about what to do with a variable.
Yeah, we talked about this a little bit in the past, like on some other episodes here, just a little blurbs, right? But we never got into the depth and the in-depth part of it.
Yeah.
So we just want to, again, educate everyone as to which steps to take and which scenarios make sense, right?
Absolutely. Yeah, I think one of the first episodes we talked about the squeeze.
Yeah.
Just be like, don't get suckered into long-term mortgages, 3 to 5 year terms. And then we talked about HELOCs, don't let that balance
term it off.
Investing's done, the balance is there. Term it off. Try to retain your balance.
Absolutely, yeah.
And you're right. We touched on some stuff, but now we're going to get into the nitty-gritty of you holding a variable rate mortgage and what to do. I'm just going to run a few case examples here, Chet. One, let's say an individual, I feel like $1 million term, a mortgage balance has been very popular, especially over the last few weeks.
Yep.
A lot of folks I've been talking to $1 million mortgage balances.
Right.
So if an individual has $1 million mortgage balance in a variable, I'm just going to give 2 variable examples.
Okay.
A deep discounted variable, that's a very good variable, or a minimal discount variable, something that's going in today's market. What a deep discount variable means is I would classify that as at least prime minus 9 or higher. Right. And there's a lot of those terms out there.
Absolutely.
And I know a lot of clients that have that, right? Yep. And I've been having deep discussions with them on what to do, right? And we'll get into that shortly. And then today's variable rate, or anybody that might have took one over the last 6 to 8 months, probably got a prime minus 40 or something like that. Prime minus 40.
That's correct. Yeah.
Right.
Yeah.
On average.
I'm
just giving average stuff, right? Every
case
is different. So now that 670 is at 6.3.
Yep.
So these are the 2 examples I want to focus on. $1 million mortgage. One is a prime minus 90 at 5.8%. One is a prime minus 40 at 6.3%. That $1 million has a $5,800 payment on your variable right now. On the 5.8 with the deep discount.
Okay. Yep.
So now that deep discount individual, you might want to hang on to that mortgage for a little bit longer. The reason why I say that is your $1 million mortgage has a payment of $5,800 stretched out over 30 years, right? This is just running case examples.
Yep.
If you were to switch that to a 5.5% mortgage, right? That's not that much of a discount, but I feel like 5.5 is kind of popular for the 2 to 3 year terms that we've been talking about. There are some good 4 or 5 year terms as well, which we'll get into, but that payment's $5,600.
Right.
So 5.5, obviously 5.8, not much difference. But now 4.5%. We feel like it's around the corner. Hopefully, these days are going to come. Now, if 4.5% is available, it makes a big difference. 4.5% at $1 million, your payment is now $5,000,
Right, as opposed to 50.
as opposed to
Yeah,
5,824.
that's a big discount, right?
Right?
$824 right off the
And interest,
bat.
5.8
Yeah,
down to 4.5.
right,
A 4.5 is not available right now.
right.
It's not, right? And
Not for the shorter terms. Again,
not
we want to
yeah,
be clear, right?
exactly, not for the shorter terms. Potentially available or soon available for 4 to 5 year terms, and
Right.
anyone interested in a $800 to $900 payment reduction, that then that speaks out to you, right? And then of course seniors or elders.
Yeah,
If you've only got maybe a small balance,
right.
5 year term makes sense.
Yeah.
You know what I
It
mean? A
does,
small
absolutely.
balance, and you're 55
Because it's
plus
safe.
age.
Yeah, it's
It's
safe.
safe.
It's
I mean,
safe,
you're not
right?
playing the interest rate game now.
No, you're not. Yeah,
You know,
you're out of that game a long time ago.
Yeah, and on those large balances, small balances for elders and
Yeah.
smaller amortizations, it's
Right.
all principal uploaded, front
Absolutely.
loaded,
Absolutely.
so it works out,
So
right?
majority of their payment includes principal as opposed to interest.
Correct. And
Right?
that
Yeah.
5.8 or 6% is kind of irrelevant because we've structured a shorter amortization for our senior clients.
Right. Right.
Right. So a
Which makes
5 year
perfect
term might
sense.
make sense for
Yeah.
them. Now over to the other case, a prime minus, somebody sitting in a 6.3% variable.
Right.
That's a prime minus 40.
Right.
Right. And that's what has been handed out, I would say, for the last 6 to 8 months.
Yep.
Anybody thinking about going variable, investors or speculators, thinking I don't want to lock in.
Yep.
Now, 6.3%, $1,000,000, your payment is 6,137.
Wow. Okay.
Right, 6,100. Now, even just jumping down to 5.8 fixed rate, you're getting a $300 reduction.
Right.
Jumping down to 5.5, $5,600 payment, you're getting a $600 reduction.
Yeah.
Now, 600 multiplied by 12 months is $7,200. Your penalty might be a little bit more than that, 3 months interest.
Right.
If you're dealing with a 6K penalty, 6
Yeah.
times 3, call it 18 Gs,
Right.
18,000. Minus that $7,200 reduction, there's still 11K to make up to break even.
Yeah.
And that's going to come from your principal payment reduction.
Right.
Hopefully, right? But if you're in a 6.3, you need to investigate. You need to investigate if it's worth it for you to switch to 6.3, get into 5.5, get into 5.4, or wait it out till those fours come back. But we're here to
Yeah.
help you calculate the break even point, figure out your penalty, and make sure it's worth your while. If it doesn't make sense, we will be the first people to tell you, just leave it
Absolutely.
alone, right?
Ultimately, the whole
Yeah.
thing is talk to a professional. That's
Yeah.
what makes the most sense, right? It's for the average consumer, it might be difficult to calculate the break-even point of this mortgage, what your penalty is, or all the million different things that we're discussing here,
Mhm.
right? So talk to a professional who knows exactly what's going on, is educated, and can calculate these scenarios for you, so you can make a smart and credible decision whether it's worth it for you to switch out now,
Yeah.
or whether it's best to wait. Right?
Absolutely.
We're typically the first ones to tell you, hey, it's not worth it, right?
Yeah.
But in situations it is, we want to guide our clients and educate them that, hey, this is the best offer for you and this is the best time to do so, because you're going to end up paying so much interest otherwise.
Yeah, if you know the broker industry, it's a win-win situation for the client and the broker
Absolutely, yeah.
because we're getting paid out from the lenders, right?
Right.
And great point, Chet. Yeah, a lot of information. Investigate this, investigate that. And all throwing all these payments out, but talk to a professional, right? But the point of the story is, if you're sitting in a 6.3% today, it's worth the conversation.
Absolutely.
You do need to speak to a professional. There are some deep discounts out there. Every lender is different. 6.3 down to 5.5. Has got you saving $600 a month, but the penalty question is at stake, and
Right.
That's what you want to figure out. So that's that, right? Just to simplify things, variable customers, what to do if you're in a variable rate mortgage, deep discounts, prime minus 90, prime minus 1. It's not going to be worth it. You might as well wait for maybe a couple more points. Every case is different, but
Right.
I'm pretty much saying, maybe wait it out for a little bit,
Yep.
because that $5-6 payment deduction is not going to be worthwhile, in my opinion, with the heavy penalty.
Absolutely.
So you do want to, get your 5.8 into like a 4% range. At least
Right.
1% reduction
Yep.
is what I'm figuring out, kind of like is making sense. So if you're sitting in like a 5.8, just basic general rule of thumb, like not even general rule of thumb, just basic calculations. I've been playing around a little bit.
Right.
A 1% reduction kind of makes a difference. It breaks you even. It gives you a significant payment reduction.
Absolutely.
And of course, we're talking about 2 to 3 year terms, maybe 4.
Yep.
And that sets the train up.
Yeah, again, everything is case by case basis, right? So every situation is catered to you as an individual, and it's important for us to understand your situations so we can help guide you in those scenarios, right?
Yeah.
It's not a one solution fits all. You can't search it up on Google. hey, what should I do with my mortgage? Like we do if we have some sort of illness, right? Or just a small little cut or whatever it
Yeah,
may
I'm
be,
talking
right?
about $1 million mortgage. Your
Yeah,
mortgage might be 800,000,
yeah,
400,000, 300,000. But the topic of discussion is what to do if you're in a variable.
yeah,
Talk to a professional, figure out how many months you got left, what the penalty is,
absolutely.
and I would say try to make sure you got at least a 1% reduction. You
Right.
got a 5.8, go for a 4.8. Wait it out and wait for that and hang on to that. That's where it makes sense.
Absolutely. Yeah.
And
And I mean, say those rates aren't available today, right? Talking to the professional today will alarm the professional that, hey, this person is waiting for this rate or is waiting for this, right? So when the time comes, that professional can guide you down the right path as opposed to you just waiting and thinking, okay, I don't know when that's happening, right? Talk to a professional so you're best guided.
mhm.
And yeah,
Absolutely. And adding on to Chet's advice, there is just a little rate holds. This is a refinance we're talking
absolutely.
about.
Yeah.
You have a mortgage, and we are looking to either refinance that to a lower payment, lower rate, or not. So we can do a rate hold. So if today, you're sitting at that 5.8%, and you're like, hey, I do like 5% even, that's almost 0.8.
Right.
You can lock that in for 120 days, get
Yeah.
you approved. You actually don't even have to act on it.
Yep.
So now within the 120 days, if that 5% becomes 4.7, 4.8, or there's more rate reductions or more banks going bankrupt in other countries, then your rates might drop even further. So
Absolutely.
you can actually entertain that 120-day rate hold,
Yeah.
right?
Yeah.
So I want to make that point as well.
Oh, absolutely. No, thanks, Larry. That was some great information there with regards to fixed and variables.
Yeah. One more example on the
Yeah.
$1 million topic. If you have a $1 million, I had a client actually, a case that I was working on, $1.3 million HELOC, home equity line of credit.
All right.
Paying $7,800 a month. That's 93,000 interest only.
Wow.
1.3, right?
That's a lot. Yeah.
And now, even switching 1.3 to 5.5%, which
Right.
is available, very
Yeah.
common, 2-3 year terms. It's out there,
Absolutely.
right? We can get 5.5.
Yep.
This client's payment's going to go from 7,800 to 7,300. That's $500 off.
Yep.
But the total annual contributions drop from 93 to 87K.
Right.
Within that 87K, there's a 17K principal payment.
Yeah. Absolutely.
Or this person cruises that 1.3 HELOC for 100 grand a year in interest.
That's
So
significant.
back to the home equity line of credit topic, 7.2 is expensive. There could be rate reduction, but there's a 2% reduction from a HELOC to a fixed term, so it's definitely worth it to switch.
Yeah. What is that? Like $24,000 in savings for the whole year.
Yeah.
If they were to act on it today.
You got it.
Right. So that's significant, right? For anyone, $25,000 is quite a bit of money.
Yeah,
Right.
absolutely.
So no.
So that's the
absolutely.
little tidbit on variables and rates, I guess, on the residential side. I'm going to pass it over to Chaitanya here
Yeah.
for a little bit of commercial insight as well.
Absolutely. So I think I'm gonna talk a little bit about one of the main topics. It's hit headlines, it's hit the news. We've seen it across the board. That's exactly it. So we're talking about Silicon Valley Bank, the largest bank failure in U.S. history since the recession,
Since 2008.
since 2008, right? So since the financial crisis. So this is significant because the Silicon Valley Bank was the 16th largest U.S. bank in the country.
16th.
16th.
There's a ton of banks in America.
There's thousands,
Yeah.
right? Thousands, as opposed to like how we have our big six banks, right?
Yes.
We got the Scotia, we got TD, CIBC, National Bank. What am I missing? I don't
The
know,
5
others.
organizations that run Canada.
Yeah, exactly. That run Canada. Exactly. Yeah. So we have 6 main banks. The U.S. has thousands of them.
Thousands.
Right.
They have so many small little credit unions
Absolutely.
and moms and pops. Lenders have become banks.
Which makes it extremely challenging for regulators, right? And as an economy overall to determine as to what's going on, whether the population's money is safe, right? So this Silicon Valley Bank, it was a tech-focused bank. Majority of the people did not know about it for God knows how long, right?
Mhm.
And have just come across it because it's made news headlines today, right? So it's important to say this. What really happened here was pretty much in simple terms, they incurred a loss, right? They were facing losses every day because the securities they were buying, the investments they were making were decreasing in value over time, right?
A lot of mismanagement.
A lot of mismanagement. Mismanagement is the key word
Yeah.
there, right? Because this bank did not have a chief risk officer for the last 8 months. So no one's been at this bank for the last 8 months actually managing the risk of the portfolio and what's going on.
And
Right.
every time we talk to clients, we do assessments. The very first thing you do is do a client risk assessment.
That's the first thing we do,
And they
right?
don't
And
even-
we know that as brokers, right? And this large bank is sitting there; they haven't even done that at all.
So they felt that one paper alone was sufficient. We don't need a risk manager.
Yeah, I guess so, right? I guess so.
Man.
But that's really what happened. And over time, this bank kept losing money because the investments it was making was banked on the interest rates. As interest rates went up, the face value of their investments was decreasing, right? So as a result, it caused a bank run, which pretty much means the large depositors, billionaires went to the bank, took out the funds, right? Caused a huge problem,
Oh, wow.
and of course,
Who wouldn't?
led to bank failure, right?
Yeah.
Who wouldn't if they thought their funds were at risk?
With that kind of spread, I mean, if you're that highly levered,
Absolutely.
which honestly, I don't even think a bank should be levered
Yeah.
like that, risking the
Well,
public's,
no, absolutely. I think it's one of those situations where they thought this was a safe bet because it was a long-term hold for them,
Okay.
right? Their intention was, yes, today that investment is not worth as much, but in the future it will be. But what was happening was they were incurring more and more losses as the face value kept decreasing today. So they forgot to look at today and we're thinking about tomorrow, right?
Yeah.
That's really what was happening.
They're allowed to look at tomorrow, but you mentioned billionaires or some investors
They're looking
got
at today.
spooked out.
Yeah, absolutely.
And
Yeah. So it led to a crash of the bank. Of course, the government ended up bailing them out. But the moral of the story is we really don't have to worry, right? In Canada, right, we have our 6 largest banks, right, and we are so tightly governed, and regulators, the OSFI, CDIC, all these organizations are in place to kind of help protect us, right? We're a tight knit banking system as opposed to the U.S. having thousands of banks.
Yeah,
and
it is.
key.
It's a gong show over there. Like,
Absolutely.
I mean, just take one example: our Canadian stress test.
Right.
Look how organized that is across the nation, all 13 provinces.
Absolutely. And why are we able to do that? Because we have 6 large banks, right, where majority of the volume is. So we have to have. It's easier for Canada as a government, as a country, to organize and facilitate this consistent rule across all financial institutions, so that it doesn't have situations like this or cause issues to deposits for clients.
Yeah.
Right. So we have to say that Canadian banks have almost a 0% chance of failure. So it's important to say that. Mr. Trevor Toom, he's a chief economist. He suggested that as well. That was his quote.
It's truly true. Being in the industry for 15 years,
Absolutely.
best underwritten banks in the world.
The world,
we all know how tough it is to get loans.
Yeah,
right?
It really is. So
we're not handing out money, and good for Canadian banks because
Absolutely.
Canadians are resilient. So everything's matching up nicely.
Yeah. So the moral of the story is we don't have to worry as a country or as individuals, belonging to Canada and being a part of this country, as much as so as the United States.
Yeah.
Like
let's not worry Canadians about banks or institutions going down or
Absolutely.
pulling money out of your bank account.
Yeah.
You came up with a really dug up a cool stat about something about insurance protection. We were talking about
absolutely.
Did those folks lose money? I mean, people in Silicon Valley Bank, from what I understand and everything I've read, have not lost money. The average public is protected, is insured, and they get their money back. And then that led to a brilliant thing something that stood out to me that you mentioned to me.
Absolutely. So in Canada, the normal protection insurance that an individual has per account by the CDIC, which is a Canadian Depository Insurance Corporation, right? Them as an institution, they insure up to $100,000 in each bank account. So each account, I'm talking about not each individual, each bank account, right? So say, for example, you have 5 bank accounts. Don't leave $500,000 in one account.
It's not insured.
Spread them again amongst 5 different accounts, right? 100K, 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 right? What that's going to do to you, in normal circumstances, that 100K is protected. Those are normal circumstances. There are situations, and say, God knows what, say, situation like that happens, which again has 0% chance of happening, the larger deposits will still be protected, but through a much deeper investigation and more things being involved as part of this process, as to see who can insure the money for the depositors, right? Which is us. We deposit our money in these banks, right? So it's important to say that we normally are protected up to 100,000 in Canada.
It's really
an
good to
important
know.
stat.
Interesting to know.
Yeah,
I mean, there's a lot of folks out there that, I'm not a scared type or anything.
Right,
and,
right.
this is not, let's emphasize too that this is not, in any means to kind of encourage you to do this. We're really well protecting Canada, right? I mean,
absolutely.
and
We're
this
really
is not,
well
we're just
protected.
actually a topic of discussion to talk about Silicon Valley Bank, and
Yeah.
we're just relating it
This
to the,
is just news, right?
just
and
news,
relating
yeah.
it to Canada and
Canada.
how it applies to us as a country,
Yeah.
and how it's still important for us to understand these facts and understand what's going on in the world and how it could possibly impact Canadians.
Absolutely. It's just
Right?
knowledge is power. Education
Absolutely.
is the best thing that we can absorb.
Yeah.
So thanks for that. 100K each in your account.
Yeah.
You get to go. You got $500,000 spread it out. If you don't need to, right? Emphasizing you don't need to, but we're just providing info.
We have clients all across the board, right? We have first-time home buyers. We have high net worth individuals.
I mean,
a smart investor doesn't leave $500,000 $1 million in the bank, right? You have them invested into
a smart investor doesn't leave anything behind.
Absolutely. Right. They do not. No, absolutely. So you either invest your money, or what the situation may be, call us if you want to get a mortgage, right? For a property purchase. Buy some properties. But a smart investor doesn't leave 6 figures or 7 figures in a bank account. You typically invest that money so it can keep growing and keep compounding.
It's usually temporary. Like, a sale gets made, money hits the account, and now you're figuring things out.
Absolutely.
But, that could be a year, it could be whatever process. And
absolutely.
Going back to what you said, we're not in that state. But I mean, if you are in that transition period for 12 months, might be smart to spread it out.
Right?
Yeah.
But again, we're not in that state. Yeah. Canada as a country is completely safe, right? We do not have any risk of this. Most economists have looked into this already. There's organizations working in the background working on this. So your money's protected. Again, our main goal is to educate the consumer, and pass on the knowledge that we have, because it might help someone else. Right?
Absolutely.
And that's really what it is.
Yeah. And what happened in America, the Silicon Valley Bank going under, just like 2008, it's honestly just bad management, bad underwriting.
That's what it is.
And in Canada, like Chad said, we just don't have to worry about that. Our banks are so well underwritten.
Absolutely. And we are one of the best underwritten countries in the world, right? We're well protected, and that's for good reason.
Absolutely.
Yeah.
So that is it, guys, for today. Yeah. On that, some closing comments. Please remember, guys, everything discussed during these episodes is not financial advice. Just information to educate you guys, the consumer, drawn from our personal and business experiences. If you have any specific questions about your financial situation, like the ones we talked about in our episode today, please contact Brightcap Financial, City Center Mortgages. Contact info can be found in the description below. And also, guys, if you are listening to this episode, please share this with a friend. We're trying to grow this page with, fellow Canadians. We want to keep dropping knowledge for the youth and, everybody in Canada for the finance sector. So that would be appreciated. Yeah, absolutely. Like, review, subscribe. Thank you guys for tuning in again, and we'll see you guys soon. Thanks, guys. Have a great day.